This is Dividend Investing for Everyone. Welcome to my channel. I am going to share with you a stock today that I am buying right now that I think is one of the best values. It is one of the best values I have seen in a really long time. But before I share that stock, I want to share my track record. Just about a year ago, I was doing something crazy on my channel here. I was talking about a stock that I was buying at the time, and it's a stock that a lot of you are probably familiar with. It is Starbucks. Just about a year ago, this was in June of 2018, I started buying a lot of Starbucks, or I had been buying Starbucks before that, but I added to my position in a really big way. Why did I do this? They announced their Q2 earnings report, their 10Q. The earnings were not what the analysts, what the street was expecting. There was some softness in the business, and there was some store closures, and a lot of the softness was overseas. It was in China. It was related to some delivery issues that they had with basically the equivalent of kind of like the DoorDash or Uber Eats, that type of thing in China. They were having some issues with that, and it hurt their numbers. And so as a long-term value investor, I took this opportunity. I jumped on this opportunity, and I added some shares to my portfolio of Starbucks. I added it $48.14. That's where I bought. Now, if you fast forward just over a year to July 28th of 2019, so 1 year and 1 month later, where is Starbucks trading? It's trading at $99.11. So just in that 1 year of time, in terms of capital appreciation, not even counting the dividends that I received, I am up 106% on Starbucks. And so the reason I am planting this seed here, the reason I am sharing this Starbucks story first is when it was a year ago, everyone thought I was crazy. Well, not everyone here at least. This is a community of like-minded investors. We are dividend investing for everyone. So there are a lot of folks here in this community who saw exactly what I was doing. They understood it, and they had similar philosophies, similar mentalities themselves. But I'm talking about Wall Street overall. There are a lot of people out there who thought I was crazy because a year ago, everyone thought, hey, Starbucks is running out of steam. Hey, Starbucks isn't going to grow anymore. I even got a comment or two here, hey, it's just a coffee shop. Someone else is going to come in. They're going to replicate their model. They're going to do it better. They're going to build a better coffee shop, and they're going to eat Starbucks lunch, and Starbucks is going to be gone. That is the type of environment when I like to buy. I like to buy world-class companies with really solid fundamentals when there is pessimism in the street, when people don't like it, when they have a bad quarter, so on and so forth. And so that is the beauty of value investing. That is how I invest. Let me tell you though, I'm not buying Starbucks now. No way. I think it is overvalued, quite frankly. If I look at the PE ratio, it's about a 35. That's on a forward basis for 2019. I'm reinvesting my dividends now because I never penalize a winner, and I buy and hold forever. So I won't be selling any Starbucks stock. I buy and hold forever because I'm a dividend investor. I will use the dividends to pay bills, and I'm already using some of my dividends to pay bills. But anyways, I just wanted to share that as the preamble to today's video because this is exactly what I think is happening again. I think it's happening again, and I think it might be happening in an even more amplified manner with this other stock called AbbVie. So AbbVie just released their earnings report, their quarterly report. I have it right here. It's, what is this, like 15 pages or so. Printed it all out, went through it in detail. This is AbbVie's 10Q for Q2 of 2019. I'm going to go through what I learned from this quarterly report. I'm going to go through the fine print. I know a lot of you out there actually have been asking me, Ian, how do you analyze 10Ks? How do you analyze 10Qs? These are the annual reports and quarterly reports. I want to do more of that, and I'm going to do it in bits and pieces throughout my videos. And so that's what today's video is going to be about. I'm going to go into AbbVie. I'm going to share why I think it is the Starbucks like Starbucks was a year ago. I honestly think it's even more amplified. I'm seeing some really good things with AbbVie right now. There are some risky things too, but with any investment, there's always risk. And I'm just sharing my personal journey here, but this is a stock I'm buying now that when I look out a year from now, 2 years from now, I think it's going to be very similar to what I experienced with Starbucks. I may be wrong, but I'm excited to share my theory today, and I'd like to see what all of you think. Maybe I'm wrong, maybe I'm right. Share it in the comments below. It's going to be a great discussion. So let's get started with today's dividend investing video. All right, everyone. So AbbVie, I've already talked about this a bunch on the channel, so I'm not going to rehash what I've already discussed. If you want to see what I think of AbbVie, I'll link in the description below. Did a bunch of videos on it. And I even did a video on how they're purchasing Allergan and all the metrics. I looked at the annual reports for both AbbVie and Allergan, all that good stuff. It's already available. So I want to go into some net new territory today from the 10Q, from their quarterly report. And so first, I'm just going to start with some basics here. AbbVie is trading at $67 and change. It's come down a little bit again, and so I will probably be buying more tomorrow on Monday. So actually, by the time you're watching this video, it will be Monday. So today, for you guys watching the video fresh, I'm literally going to buy some more, but I already have been buying recently. And here's some things I really like. In this report, in their 10Q, so I'll tell you, people ask me, Ian, how do you interpret quarterly numbers? Well, first and foremost, I don't look at quarterly that closely. I like to look more at annual, but I do look at quarterly. When I look at quarterly, the way I do it is I go to the company website, I print out their press release, and usually the press release has a bunch of text, but then if you kind of skip into the back, it's got the numbers too. It's got the tables with all the good numbers. And so I'm going to go through some stuff that I found in this 10Q. But it's trading, one of the first things I found is they updated their 2019 guidance. And so their adjusted EPS guidance used to be 873 to 883 this year. They're actually saying they're coming in now somewhere between 882 and 892. So they upped their guidance. This is a good thing when a company ups its guidance. It means that they're confident enough to tell Wall Street, the analysts, hey, we're going to come in even stronger. We're going to do even better this year than we previously said. And so with their updated guidance range, I just take the lower end of the guidance, which is 882. If I take the current share price, I divide by the lower end of their new guidance range that the company, this isn't some analyst, this is the company themselves literally saying that this is their guidance range. The PE ratio for 2019 is a 7.68. 7.68. Let's compare that with Starbucks now at a 35. So Starbucks trading 35 times 2019 earnings. AbbVie is trading at 7.68 times 2019 earnings. So that off the bat is new information for me. I knew the PE was in the 7 range, but man, the 7.68 based on company guidance now, based on updated company guidance, fabulous. And that's the lower end of the range. Okay, so their dividend yield is $1.07 per quarter, or $4.28 per year. If I take the dividend, the $4.28 per year, and I divide by the current share price, the starting dividend that someone would receive in terms of a percentage dividend yield is 6.3%. 6.3%, as you would imagine, is a nice hefty dividend. That's a good dividend payment. And so I really like companies that have a high starting yield right now, especially for my personal situation, because I am literally starting to pay some of my bills with dividends. And so I like current cash flow. And yeah, this is actually a dividend growth company too. So it's kind of the best of both worlds. They have a high starting yield and a really high compound annual growth rate of the dividend. I didn't include the CAGR here, but it's in one of my previous videos. It's really high too. But needless to say, I like this company because it gives me current cash flow that I can use to pay my bills, which is something I'm starting to do. I'm not using all of my dividends, but I'm using some of them now to pay bills. I've talked about this before. I'll link in the description below. So I love this. This is music to my ears. Now, payout ratio. Payout ratio is a really important metric for dividend investors because it gives a sense of how secure the dividend is. Payout ratio is really different per industry. Utilities, it's pretty high. SIN stocks, we discussed this in a recent video, it's really high. It's high because the SIN stocks don't want to have a lot of cash sitting around because they become a target for litigators. Now, if a kind of traditional company, standard company like a consumer non-cyclical or a pharmaceutical or tech company, I like to see payout ratios somewhere between 40% and 60%. So coming in here at 48.5, I'm happy with that. And how did I calculate that? I take the dividend, I divide by their earnings per share, the low end of the range of their forecast, and it comes out at 48.5%. So really good payout ratio. They're paying just less than half of their earnings out to shareholders like myself as dividends. And as a shareholder, I love being a dividend investor because I'm rewarded for the company that I own. I own this company. I expect the company to pay me some of the profits, and that's exactly what they do. All right, now I want to get into the meat of this. I get this question about AbbVie, and the question actually stems from this. This is Yahoo Finance, and so a lot of people go to Yahoo Finance, including myself. I love it. One of my favorite websites. If you go to Yahoo Finance, you look at the PE ratio trailing 12 months for AbbVie, you look it up, it's 24.74. So you probably can't see that, but it says 24.74. And people wonder, Ian, you're telling me the PE ratio is 7.68. Yahoo's telling me 24. Who do I believe? Ian, are you wrong? Well, no, I'm not wrong. I'm actually more right than Yahoo is, and I'll tell you why. So in the world of accounting, and I've talked about this in videos before, in the United States, there's this concept of GAAP, or GAAP, Generally Accepted Accounting Principles. And GAAP earnings, they have to follow a very specific formula. There are finance experts I know on this channel who follow this channel. I love you guys who do this for a living. They literally prepare GAAP earnings and GAAP statements for a living. Now, the challenge with GAAP is sometimes it throws off the real results of the business, and it muddies the waters, basically. It makes things confusing. And so sometimes what a company does, like AbbVie, is they also report what's known as adjusted earnings. And so AbbVie actually adjusts their earnings. And so basically, I'll give you an example here. This is just for Q2, but it says in the Q2 earnings report, the 10Q, and I'll link to this in the description below and in the comments so you guys can follow along at home. I know everyone out there in this community, a lot of folks at least have expressed an interest in becoming more savvy at these types of technical reports, this type of technical discovery, because that's what at the end of the day makes us all better dividend investors. So I want you guys to follow along at home. Now it says AbbVie reports second quarter diluted EPS of 49 cents on a GAAP basis, but the adjusted diluted EPS is $2.26. So there's a big discrepancy here. GAAP for this quarter was 49 cents, adjusted was $2.26. And so again, Yahoo, what it reports is GAAP. What I'm reporting is adjusted. Now, adjusted, what are they adjusting here? So I'm going to, even before I go into what they're adjusting, I'm going to give their guidance. They actually lowered their guidance for the year on a GAAP basis. And so many investors, they may be headed for the hills. They may be running kind of like Starbucks a year ago. AbbVie, their 2019 GAAP diluted EPS guidance range used to be 726 to 736. Now it's 569 to 579. They're lowering the GAAP guidance, but it goes on to say on an adjusted basis, they're raising the guidance range from 873 to 883. They're raising it from that to 882 to 892. So we already discussed that. So this is interesting. The numbers that some people are seeing on Yahoo on a GAAP basis, they're bad, which implies a high PE ratio, which implies low value, and they're getting worse. But on the other hand, on an adjusted basis, which is what I look at, they're getting better. Why is this? Okay, I'll tell you. So it says the GAAP results are inclusive of a non-cash charge for Skyrizi. That's the name of a drug that they're working on. Contingent consideration following regulatory approvals in the second quarter. Okay, this is awesome. So what the heck does this mean? Well, I didn't know. I don't work in the pharmaceutical space. I'm not a pharmacist. I'm not a doctor. I don't know a lot about this stuff. I like investing in this space because it pays me a huge dividend. So I just start looking, and these are the types of skills that I want others on the channel to learn. This is what I think a lot of people want to learn. And so I'm going to go on. I go to the second page and I look again. It says, okay, they recorded $2.3 billion increase in fair value of contingent consideration related to Skyrizi future milestones and royalty payments, which was primarily due to a higher risk-adjusted cash flow forecast following regulatory approvals in the second quarter, as well as lower discount rates. Again, what does this mean? It's kind of confusing. I had to read some of this stuff a few times, but I'll tell you, I know what it means now, so I'm going to keep going on. So here it goes on again. This is on page 3. I love this report because it gives all just these bullet points. It tells you what's going on in the business, both the good and the bad. Obviously, it's biased. They're probably trying to highlight more of the good stuff. But then it says, AbbVie announced the U.S. Food and Drug Administration, FDA, and European Commission, EC, approvals of Skyrizi for treatment of moderate to severe plaque psoriasis in adult patients who are candidates for systemic therapy. The approvals are based on results from 4 pivotal phase 3 studies, and then it goes on to say they evaluated more than 2,000 patients with moderate to severe plaque psoriasis. Skyrizi is part of a collaboration between, I'm not even going to, how do I pronounce this? Boehringer Ingelheim? That's not bad, I did it. BI and AbbVie, with AbbVie leading development and commercialization globally. Okay, so what did I do next? I went to Google University and I just typed in, what is contingent consideration? It brought me basically to a web page that was a web page, kind of like a blog for people who are accountants. And I looked at, it's kind of a web page trying to teach accountants about GAAP accounting. And I started reading, what is this contingent consideration? Basically what contingent consideration means is it's an earn out. In layman's terms, it's an earn out. What it means is, hey, now that this Skyrizi, I'm probably pronouncing it completely wrong, just like I pronounced Humira wrong. I just can't get these drug names right. But basically what happened is they got approvals. They got approvals from the FDA, from the EC, and what it means is, okay, they have this partnership with this company called BI, and BI now gets a higher earnout. Because they reach these milestones, BI gets a higher earnout. And so what this means is a lot of these collaborations, acquisitions that these drug companies do, they'll have these collaborative relationships, and then they'll put in the fine print, hey, if the drug actually ends up working, if the drug actually gets approval of the FDA, you, my business partner, you're going to get more money from me. You're going to get a higher amount of money. And so what happened in my understanding is AbbVie took a non-cash charge in Q2 of 2019, and it was a big non-cash charge. I'm actually going to fast forward here to further in this thing. Let me find this real quick. Here it is. It looks like just major charge of $2.3 billion, and they 2.304. So they took a big charge, and this is non-cash, but it's related to future payments, royalties that will go to BI because Skyrizi passed a certain milestone. And so GAAP accounting is really weird because it forces AbbVie, the way that their accountants do things, to take that as a charge just bam right now, even though cash is not leaving AbbVie's bank account right now. But the accounting rules, the GAAP accounting rules, force them to take the charge. And so the GAAP earnings look really poor, and Yahoo Finance PE ratio looks really high. A lot of investors head for the hills. It's trading at $67. But when you actually read what they're trying to tell us in the fine print, the adjusted EPS for the year is up. The adjusted EPS is up. They're raising it, and this is actually a good thing. They are taking this charge, this contingent consideration, but we want them to take that charge because it means this Skyrizi got approved. This thing got approved. It's going to generate revenue. It's going to generate increasing streams of revenue for the company that they can use to pay dividends. And yeah, they're going to have to pay some of that over to their business partner, BI, but it's all good. It's all good, and they're forced to take that charge on GAAP accounting right now. And so that's how I look at companies. That's how I do things. And so this is really important to look, in my opinion, at an adjusted PE versus the GAAP. Now, I think GAAP is good because in the long term, it's a good single source of truth. I think it's good to keep us all honest. But with a company like this, with a lot of, and it's case by case, but a company like this with a lot of innovation happening, a lot of business partnerships, the accounting on a GAAP basis gets funky. It gets funky, and we're seeing that right here with this huge non-cash charge in Q2. And so you may be wondering though, but Ian, these guys had a high PE ratio on Yahoo Finance before Q2, before this Skyrizi thing. What was going on? I did not look back at that yet, but I'll let you do that. Go. That's the homework from today's video. If you want to, in my opinion, be the best possible dividend investor, you really want to learn this stuff, pick up all the 10 Qs from prior quarters and go through. I bet you there are other adjusted versus GAAP issues going on. And because there's so much going on with this company now, I like to look at adjusted. And I'm so happy they got approval for this. So I want to point something else out again with this company that they're working with, Boehringer Ingelheim BI. Here's something interesting. AbbVie announced that it has resolved the U.S. Humira litigation with BI. Under the terms of the resolution, AbbVie will grant BI a non-exclusive license to its Humira-related intellectual property in the United States. The U.S. license for BI will begin on July 1st, 2023. BI will pay royalties to AbbVie for licensing Humira patents and acknowledges the validity and enforceability of the licensed patents. AbbVie will make no payments of any form to BI. So this kind of gets us down here to Humira. I know I say it wrong. That's just how I do it. But it's so interesting. It's so interesting that everyone is so scared about this patent expiring. But I am going to squash some of that criticism, some of that concern right here in today's video. That's what I want to do next. But it was so interesting just in the fine print of this thing. It goes into that. It talks about that. And what's fun about this is AbbVie is being proactive. They're going out to people with biosimilars. They're going out to other companies who may want to license their IP. And they're working with these companies to achieve settlements, to achieve agreements, so that AbbVie gets royalties. So even in 2023, when the patent expires in the US, it's already done so internationally. We'll talk about that in a minute. It's not like, oh, if consumers just go and switch drugs, which actually is quite difficult, but let's say they do, AbbVie's still going to garner a lot of the revenue because they have royalty agreements with the competitors. And so I thought that was cool. But actually, before I even get into Humira, I'm just going to show you something again. I think this is really important. I got all the text in the beginning, but then you go to the end of this thing and it starts talking about numbers. And so if you want to learn more about the GAAP versus non-GAAP, what you start doing is you go to like their consolidated statements of earnings and you just start looking at stuff, and it has like an other expense net, and it's really big. And then there's kind of like a star at the bottom. It says refer to reconciliation of GAAP reported to non-GAAP adjusted information for further details. And so that's what I do. I go to the reconciliation of GAAP versus non-GAAP, and that's where you see literally in here, it says change in fair value of contingent consideration, and it shows $2.3 billion. And so again, this is important. It's important just to look at the fine print, to look at the numbers, because it's all right there. And you can see that it's a non-cash charge, but it's a change in the value of this contingent consideration because this drug passed certain milestones. And so all good stuff in my opinion, but can scare a lot of people and confuse a lot of people out there, and creates value. But I'll tell you, why is AbbVie really down? Why is this thing really down? It's down because of Humira. We talked about this before, but I'll give a really quick recap. Humira is 61% of revenue. Once AbbVie merges with Allergan, which I hope happens, Humira revenue will be down to 41% of the total company. But what's going on with Humira? I want to look at a worst case analysis here, and I think we can do this because we have data from international. In the US, Humira, in the latest quarter, this again is from their 10Q, it's up 7.7%. Humira is still growing here in the US. It's great because the consumers don't have other options yet. They will in 2023. Internationally, it's down 31%. So Humira is going down. So I want to just do a worst case analysis. Let's say Allergan doesn't happen. Let's say the merger doesn't happen. So we're dealing with Humira at 60% of revenue. I'm also making the assumption, because I didn't go too deep on this, the revenue and the earnings are kind of similar. So Humira makes up 60% of revenue. It also makes up about 60% of earnings. I'm just making that assumption. And I could validate that, but this is broad brushstrokes here. This is, you'll see in a minute why it probably doesn't matter one way or another. No international at Humira is down 31%. I'm going to say things get worse. I'm going to say Humira overall goes down 50%. So worst case, I'm just going to say it goes down 50%. So I know that 50% of 61%, because we know Humira is 61% of the business. If they lose half of that, they're going to lose 30.5% of their business. Literally, that's a worst case. I think they lose half their sales from Humira. And, I don't think that will happen, because even if they do, they gain it back elsewhere from all these royalty agreements they have. But let's say they do. Okay, well, if I take their earnings per share this year, which is the low end of the range at 882, and I multiply it by 69.5%, because they're going to lose 30.5% of their business. Again, Humira is not 100% of the business, it's 61. So if they lose half of 61, that's 30.5. They're not losing 50% of their whole business, they're losing 50% just of Humira. And again, this is an aggressive case in my opinion. I don't think they'll lose half of Humira, but we'll see. If they lose half, basically what this means is their overall business loses 30.5%. So what does that mean for EPS? It means I take the current EPS, the forecasted, I multiply by 69.5. So that will give me the EPS as if we lose half of Humira, half of the earnings. Okay, EPS comes out to 6.1299, 6.13. If I take the current share price, I divide by 6.13, which is the EPS assuming that they lose half of Humira, I get a PE of 11. Okay, maybe the PE goes from a 7.68 to 11, but that's a heck of a lot better than 35 here up at StarBucks. And I know it's not apples to apples. You can't compare it. I never would. But, it's just interesting in the scheme of things. An 11 PE, pretty good. But then people think, oh, they lose half their earnings from Humira. They can't pay the dividend. That's not true. If their dividend is $4.28 a share and their earnings $6.13, payout ratio goes higher, it goes up to 70%, but it's still doable. Payout ratio of 70% is a lot worse than what they're at now, which is 48.5%, but it's not bad. They can pay it. And so what I'm trying to say here with this analysis, I have real data from the 10Q as to what's happening internationally. Internationally, they say right now, or they're reporting Humira's going down. Sales are down 31%. I'm saying, okay, 31%, that's not bad enough. It's going to go down 50. It's going to do 50. Even if sales from Humira go down 50, they're still coming in at a good EPS, PE of 11, and a payout ratio that's doable. And I don't even think this is going to happen. And all this assumes the merger doesn't even go through. If Allergan comes through and the merger happens, it's even less impactful to the total company. And so what I'm trying to say here is, look, there's risks here. I'll tell you the risks. The risk still is the concentration in Humira. The risk is the huge debt that this company is going to have combined with Allergan. And the other risk is U.S. healthcare system is broken. Certain government type people and certain political parties do not like the prices that these companies charge consumers for their drugs. So is reform going to come? Is the government going to attack these guys? That's certainly risks, and that's why this will always be a smaller position in my portfolio. It'll never be a top 15 stock. StarBucks is a top 15 buy and hold forever. I love it. AbbVie is buy and hold forever, but it's not a top 15 stock for me. It's towards the bottom of the portfolio in size, and it will stay there. But what I am trying to say is I think all of this drama is so overdone here, and it creates a buying opportunity, and that's when I like to buy. This is how I do it. I buy when Starbucks is closing stores and when things are going bad in China. I don't buy now. The problem is a lot of investors, they're buying Starbucks now because they're like, hey, Starbucks was up 9% on Friday. If I don't buy it, I'm going to miss out. The thing is people buying Starbucks now, they've already missed out on so much. It's probably not the best time, in my humble opinion, to buy Starbucks, but a lot of people, that's the psychology of it. But then they see something like AbbVie and they're like, AbbVie, they tell me they're going out of business. Everything looks so bad. But this is that's why I don't listen to that. I listen to this. I read this. This is what I look at. I look at the numbers, the facts from the 10Q, and it tells me something. It tells me some interesting things. And so, look, this is a riskier one in my portfolio. I don't know what will happen, but I like taking on that risk, given that I think the worst case is more than factored in here. Mr. Market has, it's a pendulum, and it swings way too high in one direction, way too low in the other. Here it's kind of, I'd say, a little too high. I think Starbucks, it's a great company, and look, I love it. One of my favorites, but it's being a little bit irrationally exuberant here, to use Alan Greenspan's terms for Starbucks. But for AbbVie, it's just being punished too much, in my opinion. But we'll see. We'll see how it plays out. So I want to share something else with you all before we close out today's video. I have some really exciting news for the community. I have launched a private Facebook group. This is open to everyone in the community. Everyone already who has downloaded my dividend portfolio has already received an invite, and a lot of you guys have signed up. We already have 835 members already, and this is just since Friday, and so we're doing really well. A lot of discussion going on there. It's open to everyone. This is Dividend Investing for Everyone. So if you're interested, please head on below. I'll include a link to the group in the description. Also, I'll include a link in the description to my portfolio. I do suggest you may want to download my stock portfolio. It's free for anyone to download. Feel free to check it out if it's of any interest to you, just sharing with the community. And so the private Facebook group, I am so excited. I'm so excited because it's literally, there's discussion happening there, just great discussion. I already have 159 questions from that group. This is theoretically 159 video topics. That is how awesome you guys are. I love you guys. And so check it out. Obviously, this is not meant to take away from YouTube. All the same discussion will happen here. I'll respond to all or most of the comments I can get to. I know lately it's been a little more difficult. I'm having a tough of a time juggling everything. My family responsibilities, my job, this fun stuff I do on YouTube is my side hustle, my hobby. And so it's my exercise. It's crazy times. And so I do apologize if you sent me an email or a question or comment and I haven't responded. I literally really appreciate them. I read them. Oftentimes I can't respond to all of them these days, but I do my best to allocate time to get to them. And so one thing though I want to point out here on the Facebook group, important, very important, and this is for, this goes for YouTube too. I do not share links here on YouTube very frequently for affiliate programs. Once in a while I have in the past, like when I was just getting started, and it was actually on different things, not even related to investing. And it's stuff I believed in, stuff I love, really love. But you'll notice platforms, there's certain brokerages, and people ask me, what about this or that? I try to stay neutral on it because honestly, I think people put too much emphasis on brokerage. I think personally, go with the big guys, go with the big names, someone you trust. I also like dividend reinvestment plans, transfer agents directly with companies. So there's a lot of options. But I've done videos on this, so I'm not going to rehash it. But what I'm trying to say is I purposefully do not make this channel centric to a certain brokerage. And the reason I don't do that is I believe it kind of just takes away from the collaborative nature of the community, because this is dividend investing for everyone. And so all I'm asking on the Facebook group and also here on YouTube is you guys do the same as me. Please do not share a referral link or an affiliate link to one of these brokerages or one of these programs. If you want to share your experience with something, please, please do that. But this community is about nurturing, it's about sharing, it's about knowledge. And look, I want to reserve the right for myself to share an affiliate link at some time in the future if there's a case where that makes a lot of sense. And so I'm not going to say I'm never going to do that. But what I'm saying, if you've been here a while, you know this channel, this community, it's very different than a lot of other communities out there. And a lot of other communities, some of them are based around one of these. They're like, hey, this channel is about my experience, or this community is about my experience with a particular platform, and here's my referral link. And so I'm not saying that's right or wrong. Hey, each to their own, but that's not what this channel is. This channel is a collaborative community. It's dividend investing for all. And so all I'm asking is please here on YouTube, if I see referral links, I just delete them. Same thing on Facebook, on the Facebook group. We're moderating those, and if you share a link, just please remove that or edit the comment so it doesn't have a referral link in it. And If you have already done that or you make the mistake of doing that, look, I ain't mad at you like Tupac. This, everyone's learning here. Look, I know everyone's just making honest mistakes or things as well. And so there's already people in the Facebook group where there's been like a referral link shared. Don't worry. We'll just edit that. Please just go and edit the link. But look, I ain't mad at you. I have nothing but love for you. And so that's what this Facebook group is all about. But I'm looking for this Facebook group really to be a hub of ideas and knowledge share, making us all better at what we do, which is dividend investing, and eventually everyone reaching financial freedom, financial independence, retire early. Financial freedom, the holy grail of all of this dividend investing. Hey, if you enjoyed the video, please subscribe. Please subscribe. And check out the description below. I'll link to the Facebook group, bunch of other cool stuff for you. Before I leave, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my personal journey here on YouTube for fun and entertainment, just my journey. Also, in terms of full disclosure, I'm long on the stocks mentioned today. I'm long. I own shares of StarBucks, ticker symbol SBUX, and AbbVie, ticker symbol ABBV. And for that matter, 3M, ticker symbol MMM. By the way, preview to the next video. Don't worry, I'll go through all the recent earnings reports on other stocks too. I wanted to start with this one. All right, everyone, please click that subscribe button and the little bell next to it. Please, best way you can thank me. I'll see you guys in the next video.